deadly, black swan, disruptive, pandemic. These are all overused words that describe the most awful year in modern history. And that makes this annual presentation really challenging because we had to read hundreds of articles and reports and digest and find the mega trends that I strongly believe is going to drive your success in 2021. So buckle in. This one is a rather wild ride. So for those of you who still don't know me, I'm a quirky and rather opinionated data scientist and technologist who buys and builds large projects. I do multifamily, student housing, industrial, self-storage. These are all favorite watering holes. Our portfolio of 18 properties in 10 states is worth nearly $400 million. More than half of our projects are new development. I strongly believe that at today's cap rates, everyone should be looking at those. The top row are large townhomes projects. The middle row and the lower row are large apartments and student housing. And the last one on the bottom right is a large industrial project. And I love all of these, but cash flow is king. So the other half of my portfolio are ugly duckling, multifamily, and self-storage projects that produce many millions of beautiful cash flow for our 400 plus investors. And talking about happy investors, as you know, track record matters a lot more than the size of the portfolio. So it's great that our investors are kind enough to write reviews for us once they've completed projects, like this review from Sarah. She has 4 active projects with us. Take a look. She's very astute. She's invested with tons of groups, so she can truly speak to our quality and our hard work. Ivan's another experienced investor. He's invested in multiple projects, very detail oriented. So what he really likes about our projects, other than the returns, is our class leading use of data and metrics to find the fastest growing cities and neighborhoods in the US. And you're going to learn about those today. Take a look at his review. And after all that awesome chest thumping, let's actually get to the matter at hand. No review of 2021 trends can possibly be complete without a review first of the year of misery. COVID caused more Americans to move than ever before. So those migration patterns are where our story is going to start. We're going to connect these patterns with some economic tea leaf reading, especially interesting now that there's another COVID bill that might pass. From GDP to interest rates to stimulus, we're going to connect it all back to real estate. And then we are going to get back to my forecasts, single family and apartments, with a special section on my Texas aha moment. So I spent a lot of time yesterday and today on James's request to deliver some Texas aha moments. Not all of them good, by the way, I'm going to warn you. We're going to finish off with the most popular section of this presentation, the shootouts. These are best cities for real estate investment. The final slides are actually dedicated to my personal picks, one national city and one underperforming city that should do really well in 2020. Spoiler alert, neither city is in Texas this year. But hey, I picked San Antonio last year, so all of you guys should know I love the Lone Star State. Before we get to the content, here's the really boring stuff that my lawyer forces on you. Educational webinar, doesn't squeeze out the risk in real estate investing. My recommendations are not magic, they're just opinions. Do your own due diligence, consult professionals, and understand that even if you do all of these things, you could still lose money. Bottom line, real estate and stocks are at-risk investments. And by the way, feel free to type in your questions. I'll take them at the end if you have time, besides the ones that James already has. All right, let's get started. Our story starts with a flashback of how the economy did in 2020, from stock markets to crazy GDP charts to unemployment to rent growth. Let's set the groundwork for the 2021 mega trends. And I'm a real estate guy, so let's start with what affects my investor profits the most: rent growth. Before the virus, rent growth in the US, rock solid at 3%. All 3 types of assets at above trend rent growth. In fact, annual rent growth had been going up for a record 39 consecutive quarters. Occupancy was at near all-time highs. All was well. And then, as we all know, the virus hit. It plunged us into a recession, killed 500,000 people, caused catastrophic damage to our services industry. But for once, for the first time I've seen in decades, Congress responded spectacularly well with the initial CARES Act. So with the Fed's interest rate cuts and the trillions in stimulus, we actually saw the stock market and the real estate market go absolutely bonkers, especially the single family market. Today, the S&P 500 is about 3,800, its highest ever, despite a second and third resurgence of the virus. And I know lots of you right now are typing, "Hey Neal, the stock market doesn't make any sense. Millions of Americans are out of work, so stock market's too high and it's going to crash, Neal." Well, I have news for you. Stock market is actually where it should be. And I'm going to prove that to you less than 7 minutes from now. All of the numbers in the stock market do make sense. You just have to dig deeper. And the first place to dig is GDP growth. The US gross domestic product was right here. Take a look at this, 33% negative in Q2, right? That's the highest decline on record. I see that in news articles all the time. You know what I don't see? Is that Q3 GDP growth was not negative 33%, it was positive 33%. As you can imagine, that is by far the best growth ever. So all in all, Q2 and Q3 canceled each other out. And while that may not make sense to you yet, I promise it will in just a few slides. Okay, so GDP balanced out, right? But so many industries were hit hard, Neal. The four largest US airlines, they lost 25 billion bucks. The NFL lost 38% of revenue. So many sporting and event venues have been closed since March. But none of these was as badly hit as the entertainment industry. Both the largest and the second largest theater chains in the US are going to be closing. And the government responded to this ridiculous pain with the largest, by far the largest stimulus in US history. $2 trillion were injected into the US economy, followed by another trillion. That's a whole lot of zeros. And the Fed, it didn't stand back either. The Fed's balance sheet increased by a staggering $3 trillion last year. The Fed bought government debt to help politicians pay for the CARES Act. In all, the Fed provided 3 times the subsidy that they provided in 2008, which have yet to be paid back, in case you're wondering, right? They lowered interest rates to zero. And as you will see in a few minutes, that lowering actually had some very unexpected side benefits. But before that, let's look at unemployment. This recession was wildly different from previous ones. In this chart, you can see the first 52 weeks of the last 5 recessions in this cluster on the right here. And as you can see, a year after they started, there were roughly 20 to 30 million unemployment claims in these 5 recessions. The orange line is the 2020 recession. Only 31 weeks into the recession, we were already at 66 million unemployment claims. That's a stunning number. That's what everyone is focusing on, and you're wrong. Another thing I want to point out is that this recession was bizarre in how uneven it was. Hawaii is at 15% unemployment, Nevada at 13%, but there are 14 states in the US right here that are still under 6% unemployment and trending downwards. Bizarre. Never seen it before. The recovery has also been bizarrely uneven depending on the education level and the income. On the left here, you can see that people with less than a high school diploma, basically low wage earners, they were the most affected. By the time we look at people with bachelor's degrees, green line, there's practically no difference in unemployment, between Feb and September.
Hello.
Now on the right, you can see that high income earners and medium wage earners, that's the blue and the dark blue line, they're also not affected much. By August, these people were back up to pre-COVID level. It's the low wage earners, the under 16 bucks an hour people that have really suffered tremendously from this particular recession. So to summarize, people with low income and low levels of education suffered the most. Tourism states suffered the most, while many parts of America have lost very few jobs. With that background, let me now jump into my favorite 3 slides of this presentation. The big aha moment of this presentation is here. The biggest thing holding investors back today is that they cannot reconcile the suffering of tens of millions of Americans with these skyrocketing stock and real estate prices. So millions of investors still sitting on the sidelines because they keep thinking that something is hugely wrong with the economy and there's a crash coming. And yours truly, me, I was one of those people. I sat by the sidelines for months, right, thinking that massive unemployment doesn't go together with booming markets. And then I decided to investigate, and this is what I found. The first bar on the left here shows how much the economy gained or lost in terms of wages. And you'll be shocked to learn that the economy only lost $43 billion in wages in the first 9 months of the pandemic. Why? Because income inequality in the US economy is so high that the people who have low paying service jobs are actually only a very tiny fraction of the US economy in terms of raw dollars. So $43 billion lost, still a lot of money, but there were gains. The second bar shows the unemployment benefits that came in from the CARES Act. Now, these benefits were 25 times higher than the same period in 2019. I say again, 25 times higher. A total of $499 billion was added into the US economy just through the unemployment clause of the CARES Act. And that doesn't even include the $1,200 stimulus checks, which added $276 billion to the pocket of Americans. Income from businesses, which the IRS calls proprietors' income, didn't go down. It would have gone down a great deal if it hadn't been for PPP programs and EIDL programs and rent relief programs. But it didn't go down. It didn't go up. It was flat. It was flat. But how many of you would have thought that until I showed you this graph? None of you. And then there were a bunch of other stimulus items added to the economy through state and local government grants, about 265 odd billion. The bottom line in blue is shocking. Compared with the same period in 2019, Americans actually had $1 trillion more in disposable income, right? I wish I could say that the trillion went to those that were in tremendous pain, but we know that's not true. A lot of it went into the pockets of those that didn't need it, people like me. But hey, it's money, and those who had more, they spent more, especially on big ticket items like Teslas and stocks and Tesla stock and real estate. So now you're beginning to understand why real estate and stocks are booming. Yes, but income's only one part of my story, right? Big changes in 2020 also took place on the other side of the ledger, spending. Let me be blunt. COVID scared the shit out of people. And when people are scared, they spend less. Here you can see that they spent $60 billion more on work chairs and gym equipment and monitors and webcams. They also spent $39 billion more on food and alcohol. But they saved an enormous amount of money on services. All that saved money from haircuts and restaurants and flights and concert tickets added up to a staggering $575 billion in savings. Americans also saved $59 billion in interest payments, ultra low interest rates, thank you, Fed. Bottom line, Americans actually spent a total of $535 billion less than they did in the same time frame in 2019. Think about those numbers. They're absolutely huge. In summary, this combo of $1 trillion in higher income and 500 billion in lower spending pushed Americans' savings rate through the roof. From March through November, America's savings were a staggering $1.5 trillion higher than 2019. That's a rise of 173%. And normally the savings rate, it stays in a narrow range, around 7% before the pandemic. Did you know it spiked to 33.7% in April? Its highest level ever? So even as millions of people faced incredible financial hardship, Americans in the aggregate were building savings at a shocking rate. And the savings all had to go somewhere. But where? Well, money under the mattress, one option, right? Sure enough, currency in circulation spiked by $260 billion. Deposits in commercial banks also up by 19%. But for those that are a little more comfortable with risk, there was investing in stocks and bonds and Bitcoin. And that is why, ladies and gentlemen, we have this insane increase in the stock market. Only it's not insane, it makes sense now. And then Americans also fell in love again with home ownership. Home sales surged massively, and more on that in a few minutes. Bottom line, the 1.5 trillion extra savings is creating a tide. It's lifting the value of every single financial asset in America. All right, let me take a breather. If you get nothing else from this webinar, at least you've solved the mystery that everybody talks about of these high stock and real estate prices. Moving on, flashbacks are over, time to look forward. Let's talk about the recovery and what it could look like in different scenarios. First, GDP. We all know that GDP, or simply economic growth, is necessary for home prices to go up, for rents to go up. So I'm delighted to see that the consensus forecast for 2021 GDP growth are the highest they have been in decades. Typical consensus forecasts have been in the 1.5% to 2% range for the last 10 years. So it's fabulous to see a number as high as 3.56%. Of course, a lot of this makes up for the negative growth from last year that you see on the graph, right? But hey, that's behind us. So we'll happily take the rebound bounce in 2021 and look on the screen. Also, maybe 2022, right? Insert smiley face. But there's no such thing as something for nothing. So when GDP growth goes up, so does that nasty hydra that we call inflation. In fact, 2020 inflation was super muted, so no challenges, right around 1%. In 2021, the consensus forecast is for inflation to jump up beyond 2%. For us landlords, that's not all bad. People say high inflation is bad. That's a nonsensical idea. While everything gets more expensive, salaries and rents rise faster when inflation is higher. As long as inflation stays in that 2 to 3% Goldilocks zone, real estate investors are quite happy. And I think you're going to be quite happy with inflation this year. Now, the third big indicator that real estate investors watch is unemployment. 2020 was, of course, crazy off the charts, but 2021 should be a more reasonable number. Now, let me be blunt. 6% on the chart is still a higher rate of unemployment than anything we've had in 7 years. And it absolutely will be a drag on wages and on investment. That's why getting another stimulus package out is the key to hitting this very rosy 3.5% GDP projection. That's why you notice the chairwoman of the Fed keeps talking about that, even though the Fed doesn't like money printing. Our last and fourth economic trend indicator is the direction of interest rates. As you know, the Fed cut its interest rates. They call it the Fed funds rate. They cut it to zero. And then they did something ridiculously unusual. As far as I know, the Federal Reserve has never, ever offered long-term guidance on interest rates. But the pandemic was so potentially devastating that they made an exception. They let the markets know they're going to keep rates low for years until 2023, right? We're in 2021. So as a result, we've had the lowest mortgage rates in history for many months, right? Today's mortgage rates for 30 years just got over 2.99. This data actually is a couple of weeks old. So we're a little bit over 3% today. And here's what the big dogs are saying. Take a look at the screen. The one on the left in green is the rate today, right? So that's, basically it's ticked up just over 3%. There are 6 agencies in the US that predict rates, and their average is a delightful 3.03. So basically the consensus is that the rates will stay at 3% average for the whole year. That's absolutely fantastic news for real estate investors. At 3%, investors can afford a 20% more expensive home than they could afford a year ago. Putting it another way, millions of Americans that would not have qualified for a loan a year ago with interest rates above 4 will qualify now, as long as they have their jobs, that is. And keep in mind, that's great for renters because homes are forecasted to go up by a ridiculous amount. And I'm going to mention that in a minute. So those are our 4 trends for economic indicators. Now let's take a look at something more fun and interesting and groundbreaking. Coming up first, disruption in America's migratory patterns. Let's find out what happened when Americans moved during the pandemic. Well, as you can see, it wasn't all good news for America's gateway metros. San Francisco, New York, Los Angeles, Chicago all lost populations to their suburbs. And where there are losers, there are winners. The Big Apple had negative rent growth because people were going to Newark. Denver lost people and rental profits to Colorado Springs. Seattle lost people to Spokane. California was interesting in that it had a super cluster of losing cities. San Fran, San Jose, Oakland, Los Angeles were in the losing team for rents. Fresno, Sacramento, and Bakersfield were the winners. Bakersfield? Really, people? Really? Bakersfield? I don't know. So it's fair to declare that this decade-long urbanization trend is completely over. As you can see, urban rent growth is now negative, whereas suburban rent growth is quite positive. People want more space, and restaurants and museums just not as important as home offices and backyards. And so people are not just moving from San Francisco and New York to their suburbs. They're leaving the metros altogether. The states in green are seeing huge inbound moves, right? We invest in Idaho with its incredible growth. It's at #1, no surprise. We also invest in South Carolina at #2, Oregon, South Dakota, Arizona, Tennessee, North Carolina, Florida. Those are the other big winners in the pandemic super migration. Notice no Texas there. The states in light blue had some inbound migration. Some people moved in, slightly less people moved out. Texas shows up there. Utah, Washington State. The states in dark pink, big losers. California, New York, Illinois, all hit very hard. But most of the Northeast states, they lost a bunch of people as well. Does not look good for you, Connecticut. In fact, I think there are only 9 people now left in Connecticut. Okay, so that was states. What about cities? Well, predictably, the big loser was the Big Apple, with 5x the losses compared to 2019. Chicago, San Francisco, Los Angeles also lost a bunch of people. And I'm happy to say we don't invest in any of these big five loser markets. And boy, did that hurt when it came to real estate rents. The green chart on the left shows one bedroom rents in big metros, one bedroom before COVID. The orange chart on the right shows a drop in rents after COVID. Take a look at San Francisco. Take a look at San Francisco. Ouch. Remember that rent losses in the great financial crisis were around 2 to 3%. We are here at 24% rent drops. Imagine what's happened to cap rates there, right? And do keep in mind down here that nationwide rents for one bedrooms didn't really go down during COVID overall. So it was just the big gateway metros that got their butts kicked. Another trend to point out was that two-bedroom rents were very, very strong. People want more space, so one bedrooms just plain went out of fashion. I'm actually very glad that a majority of our 2,000 units are 2 and 3 bedroom units. Okay, so those cities were hurt badly. What cities were the winners? Well, I'm happy to say that 6 of the biggest gainers are in markets that we have invested in the last 5 years. Though our data analytics, we did see the trends before COVID, and the virus didn't start the migration, it just massively, ridiculously accelerated them. And so these are the 6 that we invest in, but other areas that gained population were Austin, Dallas, and surprisingly, a number of slow moving Midwest markets. Let me bring them up on the screen, and you see Indy here, you see a number of them that gained a significant amount of population for the first time in years. So that was very interesting. And all these people moving shows up in the rent data that we look at, right? So predictably, vacancy rates in downtowns throughout the US spiked. You can see that spike in blue on the right there. And vacancy varied by class. Newer Class A properties were hit hard with vacancy spiking to 5.5%. Class B and Class C, not much of an impact in occupancy. And it wasn't just vacancies, rents also fluctuated. Take a look at the difference in rent growth between suburbs and urban areas. I'm happy to say that 100% of our properties are in the suburbs, so our markets saw rent increases, while urban markets were flat or negative on rent growth. Overall, looking at all kinds of properties in the whole country, rents did drop a bit. I see on Facebook people saying rents didn't drop. That's not true. It's nothing really compared to the Great Recession here. You can see how that recession hit real estate much harder. So we had small rent drops. And in fact, if you leave out the more expensive, newer Class A units, it's fair to say that rents in workforce housing, right, for common people in the US really didn't decline much at all, less than 2%, as you can see here. But just like vacancy, rent growth varied a lot. Here you can see how different markets fared. The markets we invest in are green. One of our markets, Houston, saw a tiny little drop, but the other 4 markets saw rent increases. And the market that has our biggest project, Phoenix, actually saw a huge increase in rents. What about sales prices? Well, we saw a teeny tiny dip in prices, a couple $1,000s per unit. And you can see that here, this little hook here. And I'm happy to report that this dip has now ended. And as of Feb 2021, that number is again at an all-time high. And this means that today we're seeing the lowest cap rates in history for apartments. Remember, the lower the cap rates, the higher the prices. And you guys know this. Rental collections were pretty strong throughout the pandemic, even though we did see a spike in delinquency, especially in Class C. All right, time to take a quick look at Texas. You might see a few surprises. So right here, this is the latest 3-month growth chart from Yardi. This is not 9 months. This is not the whole pandemic. It's just the last 3 months. As you can see from the middle here, nationwide, basically, there's really no rent growth, right? So either on this side or that side, right? But keep in mind, winter is usually slow, so it's not that bad. On the Class A and B side on the left, Houston is doing the best. Why? Well, Dallas and Austin just delivered a shitload of apartments. So the fact that they have over 2% annualized growth, right? This is about half percent for 3 months. That's not bad, right? On the Class C side, though, all 3 cities are around that 2% annualized range. So not much difference. Note that we are seeing something very unusual, declining Class C rents. We haven't seen those for a long time. While most cities showing rent declines are in big gateway cities here, I do see Nashville, Tampa, and Las Vegas showing decline in Class C rents. Now let's talk about forecasted rent growth. That's this column here, this third column. As you can see, Dallas is actually slowing tremendously after years of fantastic rent growth. And it's nice to see Houston move up the charts. Austin at a 3.9% projection of 2021 rent growth. Not a surprise at all. Phenomenal things happening there. You know what's a surprise is on the right here, where Yardi projects that Central East Texas, that's Tyler and Longview and Lufkin, they're going to have the fastest projected rent growth in Texas this year, over 4%. And El Paso is also going to do well at around 3% rent growth. Now, just a quick look at trends. I don't have one to show you for Austin, but as you can see, whether it's Class A or Class B, this is Class C up here, this is Class A down here, you can clearly see deceleration in Dallas, right? We're also seeing challenges in Houston, with Class A seeing negative rent growth in Houston so far. And here's my final slide on Texas. And I have a couple surprises for you. This chart shows only Class A and Class B properties in the US, and it shows the percentage of properties offering concessions. You guys are very proud of Texas, but you'll be surprised to note that 3 cities in Texas were at the top of the list when it came to concessions during COVID. Roughly a quarter of all Class A and B properties in San Antonio, Austin, Dallas offered pretty hefty concessions. You can see the numbers here. You guys are only used to sharing good news, but you should know that Texas cannot avoid the law of numbers. If you build a truckload of units, it will absolutely hurt rent growth, and you can clearly see that here on the concessions chart. All right, that was apartments. I own 10 single family homes, so I also give people a little teaser about what's happening in the single family side. It's important for multifamily people to know this. Our story really begins with foreclosures. In 2010, on the left, there were nearly 3 million homes in the US that went into foreclosure. But by 2019, only 500,000. Of course, 2020 has very few foreclosures because the government banned them. In 2021, we think it's going to tick up a bit. But those that are expecting a tsunami of foreclosures, I see this on Facebook nonsense, you're going to be sorely disappointed. Because unlike 2010, 97% of homes today have equity in them, right? Only 3% are upside down, and that number might shrink to 2% by next month. This means that when push comes to shove, owners will choose to sell rather than let a bank foreclose on them. So if you're waiting for foreclosure, good luck to you. You're going to be waiting for a while. And another reason why there's so much single family demand is the rental market. One surprising megatrend is that richer, more affluent renters are turning to rentals like single families, townhomes, upscale apartments. In fact, this graph shows that since 2012, the percentage of renters making more than 100K has grown from 8% of the market to 13%. And most of these renters are actually picking up townhomes or single family renters instead of going into home ownership. So there's a lot of upward pressure on single family rentals. Let me skip past here. Another reason why there's so much pressure is that the renter demographic in the US is changing. 20 years ago, most renters were young singles. Today, things have changed so much. Take a look. Young families renting more, middle-aged families, mature families, multi-generational families, single-parent families. All of these groups prefer to rent townhomes or single-family rentals over apartments. So as we use from young single renters to family renters, there's a lot of demand for townhome and single-family rentals, and that's driving single-family prices in the US. Another group creating demand are empty nesters. Instead of downsizing to a smaller house they're selling their homes, using their equity to finance their life, and they're renting smaller homes. And that's putting more upward pressure as well. And all this upward pressure is raising home prices in the US much, much faster than wages, much, much faster than apartments. As the median sales price, shown here in red, continues to rise, the home price to income ratio is rising because incomes are simply not keeping up with prices. And as that ratio goes up, as a consequence of this crazy rise, more and more renters are being created because they can't afford to buy a home. In fact, 50% of renters say they cannot afford the down payment to buy a home, and nearly 30% cannot qualify for a mortgage. And builders are not sitting idle. I mean, they're building and selling a lot more homes. This graph shows that except for March and April here, when the pandemic started, builders sold more homes than 2019 in every other month. And if you look at August, September, October, they were selling 300,000 more homes each month than in 2019 in the middle of a pandemic, right? The lack of land, lack of labor, and ridiculously high lumber prices mean that builders simply cannot build more. They've boosted supply as high as it can go, and you can see that from the numbers. And that is why it's no surprise to me that Realtor.com projects a 5.7% increase in single family prices with a seller friendly market. The chief economist at Redfin says that the number of sales for single family in 2021 will be so high that they will be the highest for any year since 2006. Now, he's also pointing out that home ownership rate will rise, but keep in mind some of these are actually, homes being bought for rentals. And Zillow is shockingly bullish. They're forecasting a stunning 22% sales growth over 2020. That would make 2021 the biggest one-year gain in sales since the early 1980s. And with these giant jumps in sales volume come big jumps in prices. Realtor.com actually hit it on the head. Their forecast here in green exactly match the average forecast of 5.7% from all of these top five forecasters. For my sake, I hope they're all wrong and we get the 10% with Zillow. And keep in mind, this is average for the US. Fast growing markets could grow much faster than this rate. Bottom line, single family will be an absolute rock star market in 2021. All right, time to finish with the most popular section of the presentation, the best city shootout. But before we do that, I want to show you the kind of projects that I am building for my investors to take advantage of these trends, especially those single family trends that I just mentioned, right? I'm building fourplexes in the top markets in the US. As you can imagine, they're in Texas and Idaho. And I'm building them for my investors who have 100% ownership. They're taking advantage of these crazy sub 3% single family 30-year fixed loans and building an incredible amount of equity. I love syndication, so do you, but I can tell you, anyone that uses an Excel spreadsheet for 15 minutes and forecasts 10 to 20 years of ownership will notice no syndication in the US ever matches the amount of money that you can make in a fourplex, especially because there's so much flexibility in these fourplexes compared to what we do in multifamily syndications. And there's just something about having a brand new building that is cash flowing from day one that appeals to people, just a lot less headache. So I'm building them in Texas, and boy, you guys know everything about Texas already, so skip this slide. And I'm especially building them in Houston. I'm building them in Austin. This is kind of what they look like. This is a project that we're selling now that's open to investors that that want 100% ownership, that want 30 years of depreciation, no recapture. They want they want the cash flow for 30 years. And they don't want to pay any taxes, unlike our syndications where we pay taxes every time we finish syndication. So those are some of the numbers. Those that are interested in fourplexes, let me know and I will be happy to give you more information. I'm going to skip past this. That I don't want to skip past because that's actually how they look. So those ones are student housing, though we also build multifamily in Texas, multifamily townhomes in Texas. All right, so shameless sales pitch over. I'm going to get to the last few slides, which are the best cities for real estate in 2021. Such an incredible list from Zillow of mid-sized markets. If you've seen this presentation over the last 3 years, I've been screaming about Boise and Idaho for 3 years. I mean, Idaho's economy is a supernova. Boise's at the center of it, and that's why my company keeps investing in Idaho. Tacoma is actually benefiting from the fantastic growth of Seattle, and so is Spokane at number 4. Seattle itself comes in at number 7 in this list. There you go. But for me, the biggest golden nugget, the single biggest aha moment in this entire presentation for all of you Texans is a completely unknown city called Killeen, Texas. And why is this city in the middle of nowhere so special? Well, if you live in California, you know that Sacramento has been the biggest success in California. All those Bay Area residents, they ran away to Sacramento, they exploded the rents and the prices in Sac. Well, now apply that example to the new Bay Area, to the new Silicon Valley, right? The powerhouse that is Austin, Texas. Tesla's moving there, Oracle moved there. Austin's red hot. It's expensive though, right? $437,000 for a median home. Or you can buy a median home in Killeen for $146,000. That's right, 1/3 of the price. And as Austin continues its rise, all ships nearby will rise. New Braunfels is only 32 miles away. San Marcos is only about 25 miles away. Both of these ships are going to rise and soar together with Killeen due to the Austin effect. So write that one down. Others in this list that are interesting are Cleveland and Indy, but I would like to see more population growth in Cleveland before I recommend it. But Indy is seeing rapid growth in population. So check out Indianapolis, lots of potential. Realtor.com also has a top 10 list, and they're projecting that California will take the top spot, with Seattle at number 2. I agree with their number 2 pick, but not with their number 1 pick. America's newest tech hub is Boise, Idaho, so that's in at number 3. Sacramento and Phoenix also deserve their place in the list. They're boom towns. Two less expensive cities, cheap cities in California, Riverside and Oxnard. They've been in the list for a while. At 8 and 9 are two other perennial favorites, Denver and Charlotte. Please note, for the first time in 5 years, there are no Texan cities in the list, in this list from Realtor.com. Everything cools, even Texas. Here's multifamily. That was single family. Now for apartments, yay. Top 2 are the cheap markets in California, right? So these are no surprises there. Cheap markets in California are doing really well. And with the pandemic dragging on, I don't think that Vegas is a low risk investment, but Phoenix is a powerhouse at number 4. Indy, once again, showing up at number 5. Atlanta, ever present in these lists. And so are these two powerhouse metros in North Carolina, Charlotte and Raleigh. And by the way, good to see Kansas City in this list as well. And I also matched Yardi Matrix forecast with CBRE. And you know what's interesting? They were very similar. Phoenix, Atlanta, Tampa, Kansas City, Indianapolis, and Raleigh all repeated in both lists. And also good to see Jacksonville's in the list there. But notice only Dallas showed up in this list. So there's obviously a slowing down in the Texan markets. These are not my forecasts. It's CBRE and Yardi, people that you know. So those are the top cities in the US. I'm going to end with my final slide. I'm going to stick out my neck. My past picks for best city for 2016, 17, and 18 were Provo, Utah, and Boise, Idaho. Last year, I had a tie with Raleigh and Charlotte as my joint top pick and San Antonio as my dark horse pick. And this year is my first pick ever in the Midwest for my dark horse. While crime remains a big concern, Indy has fast growing population and income growth. Home prices are going up and up and up. I'm unlikely to invest in Indy, but I do think that this market is underpriced and offers some serious bargains for all you syndicator people. So just steer clear of the very high prime parts of the city. And now, drum roll, my pick for best city in the US for real estate is Phoenix, Arizona. After missing out narrowly for 3 consecutive years, I'm happy to declare that my top pick for best market is Phoenix. It is the fastest growing large city in America. It has so much going for it that COVID has had almost no impact on its prices or rent growth. And I do fully expect that Phoenix is going to continue to fly in the coming year. So that's our show today, folks. Hope you liked it. But if what you learned today is interesting, we do 26 webinars like this at multifamilyu.com. These are all the different speakers. I do about 6 of them myself. So we're doing them every other week. In fact, we did one yesterday, had about 500 people. So check out multifamilyu.com. And if you're interested in cash flowing townhomes, 100% ownership, please let me know in the chat. And James, I hope that is data coming out of your ears yet, right? That was a fast run.
Neal, I've seen the presentation a couple times, and every time I'm still impressed and entertained. So I appreciate you going through it and adding some Texas slides for us. We're going to do sort of a rapid fire, quick fire question and answer if you've got a couple more minutes to stay on. Is that cool?
Absolutely. Absolutely.
All right, let's fire away here. Paul asks, so Paul Yazbek is the king of Killeen. So he loved that slide that you put up there on Killeen. So he has sold. Yeah.
Call me, Paul. We should talk.
So he has sold more in Killeen than anybody else. So his question is, what concerns you most about multifamily in 2021?
I think pretty much the same concerns as everyone else. that cap rates are compressing. I predict that they will compress to 4.6. They were at 5.1 just pre-COVID, and then they didn't really change much through the COVID crisis, but now they're beginning to compress again. I think they're going to go down to 4.6, 4.7. This is going to create over leveraging in the marketplace. This is going to create a bubble. Is that bubble going to burst this year? No, I think that this year is going to be an extremely strong year financially, but I think that my big concern is that on the one side you've got delinquency. This is not the single family market. Single family did phenomenally well. On the one side you've got lots and lots of delinquency. On the other side you've got all these people buying these properties. Many of them just don't know what the heck they're doing. And so I think that while I don't expect a bubble to burst in 2021, maybe not even in 2022, these kinds of ultra low cap rates usually create massive structural problems.
All right. This is the next question.
That's right. So no, I actually do not see a risk at this point in time to cap rates. I expect them to go down. So here's, for better or for worse, I'm going to stick my neck out and say we're going to drop from 5.1% where we were on Jan 1st of this year. We're going to drop to 4.7, which is a humongous drop, by the way. It's a massive drop by the end of this year. And then I expect that we're going to float around that for 2022. What happens after then? God knows. I'm not going to predict.
All right. At that point, I guess Gijo asked, when will it stop being a seller's market for multifamily?
If I knew that, Gijo, I would not be telling you. So the honest answer is no one knows. I just don't see it happening in the short term.
All right. And asks, any tips for investors adapting to this market in 2021 and any particular investments you recommend over others?
Yeah, I think the biggest way to adapt is while we love Dallas, we love Austin, I've got so many investments in Texas. I mean, I love the Lone Star State, but you have to understand that every market rises and falls. Texas has dominated my lists for the last 5 years when I've done this presentation, except for one lone showing in Dallas. There was nothing in Texas in that list, except for Killeen. Did you notice Killeen? Yes. So that was in there. Bottom line is, if you're looking in Texas, it's actually now less riskier to look at true Texas tertiaries like El Paso or the Central East markets that I mentioned, which have high projected rent growth. So if you want to be in Texas, you got to look away from the major four. That's the honest answer. If you and my suggestion would be look elsewhere and don't necessarily look in North Carolina or Florida or Arizona. I think that those markets are also extremely expensive. You might want to start looking at some of the emerging markets. I mean, Omaha, Nebraska looks really good to me right now.
All right. Here is a setup. Thoughts on the I-35 corridor from San Antonio to DFW? Anything about Waco? This guy, Anon asked.
So I absolutely adore the 72 miles from San Antonio. Actually, you're asking about San Antonio to DFW. No, I'm not seeing that corridor connect. I am seeing San Antonio to Austin connect.
That's it. Okay.
Right. So but what you're asking about is a very long corridor all the way from San Antonio to DFW. Above Austin, the only point that I'm finding interesting is Killeen. You notice Killeen's actually on that path that goes to DFW. But once you go beyond Killeen, I am not seeing any network effects. So that's where it really stops, right? So from San Antonio to Killeen is awesome. Beyond that, don't see anything. Waco's a little bit of an armpit, but the truth is that it's also projecting pretty high rent growth for this year. So it may be one worth looking at. Okay. It's not my favorite market. It's not anybody's favorite market.
Well, we'll let Baylor know that you called it Waco an armpit. James asked, what is a good process for vetting property managers? Any data that you should review?
That actually is a fairly long question.
Okay.
I think that if James sends an email to me, I'm happy to provide my email address. I'll send you a chart. I'll send you an Excel spreadsheet. Simply ask the questions and read the responses on the right, and you'll know if they're bullshitting you.
Okay. Craig asks, inflation or deflation next?
Definitely inflation. So at this point, the keep in mind what just happened was the most unusual thing that you could imagine. One of the things that prevents inflation is that different countries are at different points in their economic cycle, right? So when the US is new to the cycle, England might be coming to the end of its cycle, and so might be India or China. But for the first time in history, 200 countries reset in their cycle at the same time. Don't underestimate how powerful that is, because early in the cycle, everything booms, right? We just came out of a recession. So did 200 other countries. This has never happened before in history. I cannot imagine there not being significant inflation in the next 12 to 24 months. Also, never, ever, not even in 2008, has the entire world printed money at the same time. So when you have a huge number of countries printing, you will create inflation.
All right. Paul asks, have your previous predictions been accurate? If so, which ones? If not, what changed?
That's a long conversation, but I'll say that I wish more had been accurate, Paul, because one of the things that I did was in the past, I bet against the Fed. So what I've learned now is the Federal Reserve always has more weapons. They're endlessly creative. So all I can say is when I've lost, it's because I bet against the Fed. I hope you understand what that means.
Absolutely. Systematic methodology for exit cap rates.
No one has it. Like, like James, he just pulls a number out of his hat. That's his thing, right? So
Sticks it in there.
I use James's hat. So the true answer is no one knows that because it's your beliefs, right? My beliefs are this. So I'm going to say this publicly. You guys will beat me up. I have instructed my underwriter for the first time that my exit cap rates cannot be higher than basically today's cap rates.
So
So
flat. You're flat.
I'm saying they are not going to uncompress, and I'm putting my money on it.
All right. That's simple enough methodology right there. Best investment class ABC in the next 5 years.
I think it's B. I think that the impact of COVID on Cs has been understated. There's a very significant delinquency impact. There's going to be challenges related to that. I think that Bs are going to do really well. I also want to point out that all sorts of assets that are suburban are going to outperform. So luckily, most C properties are suburban, so you're going to see very strong performance there. But suburban B assets are going to beat suburban C assets because people want they want extra space, and a lot of those Bs are bigger in size than the Cs are.
Got it. We haven't really touched on, impact on Biden on multifamily.
So, oh boy, a bunch of Texans are asking me this question, right? I mean, what am I supposed to say? The honest answer is this. I mean, we all love bashing Democrats, but there's a lot of analysis coming in from 10 different sources. 8 out of 10 are very positive for one simple reason. He wants to spend trillions of dollars. We've noticed that it doesn't really matter whether it's Republicans spending money or Democrats spending money. Spending money tends to juice the market. He wants to spend a lot of money.
There you go. You covered this in your slide, but best secondary market for the next 5 years.
I would say they're in Idaho. I mean, Twin Falls, Idaho Falls are phenomenal. I also think that Omaha, Nebraska is a terrific market that's coming up. If you want to know, Omaha is where Raleigh was maybe 4 or 5 years ago. So those are two terrific markets. Phoenix is expensive. I'd say look at Tucson and also Flagstaff. Those are strong markets to look at.
Neal, what changed in Phoenix from the last recession? Like it seemed like Phoenix got hammered in the last recession, but now it seems like it has not stopped. Did something change there?
I have a perfect answer. I have a perfect answer, James. If you look at the pie graph, in another presentation, I showed the Phoenix employment pie graph in 2007, and I show you the employment graph in 2020. You'd be shocked at how much more diverse Phoenix has become, with technology and healthcare becoming larger pieces, right? And then cheaper areas like retail services actually shrinking as a percentage of its GDP. So cities that build more technology and healthcare tend to become more diverse. So the city has basically grown up, which is great for people that are investing in there. So there's a very significant change. You can see it by looking at the pie graph. Those are easily available on city-data.com.
All right. No, that helps a lot. Top 3 MSAs for acquisitions.
Acquisitions, yeah. Let's see. None of them are in Idaho simply because there's nothing of that size there I like the big ones. Um, Atlanta's still in my mind a good market because I track single family home prices. A lot of syndicators don't track single family home prices. I think that's a huge mistake because I feel like single family home prices are a 18-month crystal ball. If you see massive single family home price increase in a market, 18 months from now, rents are going to be massively fast. I have back tested this on over 600 cities, and it worked in astonishing 97% of the time, right? I'm just stunned people don't do it, right? Because eventually what happens is, you get single family homes going crazy. You're creating a bunch of renters that no longer can afford to buy and they want rehab units, which is what we're providing. The whole point is to provide rehab units. So bottom line is, I think that that's that's something that we need to look at in the marketplace. I see Atlanta, the projections for its home price growth are still shocking. And a lot of people are like, Atlanta's done because it's been hot for 3 years. No, Atlanta is the only reasonably priced major metro in the US over 2 million people. From an income perspective to home price perspective, it's only 6% overvalued. Boise is 54% overvalued.
All right. That's why we got Clay Allen in Atlanta. So,
Amen.
all right. Clive asks, with interest rates and cap rates projected to be low, what is your preferred loan option?
Bridge loans,
Bridge loans.
very straightforward.
All right. Sacramento is a strong market, but it's in California. Should we invest in it or avoid it? Jeannie asked.
I think if you like investing in California, it will continue being a strong market. I keep in mind that COVID creates a de-densifying effect. The San Francisco Bay Area is very dense and very expensive. There's still an incredible amount of room there. Sacramento has a lot of room. I expect that Sacramento gained five. It's been the strongest market in California for 5 straight years. I think it just got another 5 years out of COVID.
Wow. All right. Uh, Kapil asks, how are you positioning your investing business for the next couple of years?
By diversifying. I believe that the multifamily syndication business has become increasingly difficult. I've run 4 different businesses, successful businesses. One of the things is never swim against the tide. There's some swimming against the tide that's going on in the multifamily market right now. Your profits are going down, your cap rates are going in, and your competition is worsening. So I'm diversifying. If it's going to be a seller friendly market because of the Fed forcing interest rates to be low, I'm going to be a seller. So I'm building whatever I can build in extremely short amount of time. I'm building wherever I can build. I'm building,
Got it.
right? But not like 2 or 3 year like blockbuster projects. I'm building fast.
Brian asks, as an LP, what can I invest in to get a 20% IRR or more?
The only thing that I know of mathematically that will give you a 20% IRR in the future, obviously the past is not representative of the future, is fourplexes. And not even mine. I'll point you to some that people that are selling them cheaper than I am.
All right. If you invest in multifamily, what should your expectations for returns be?
Lower, quite a bit lower. I think that the truth is that we are now entering the ultra low cap rate environment. In the ultra low cap environment, the people who suffer the most are the investors. The syndicators are simply going to adjust their fees, but it's the LP investor that's going to go lower. You're going to start seeing by beginning of next year a lot of 6 prefs. You're going to start seeing 11 IRRs and 12 IRRs where you're seeing 13s, 14s, and 15s now.
Aaron asks, biggest investing mistake and how can other investors avoid it? I guess it can be you personally or something that you've seen other people do.
Well, I'm going to plug one of my seminars. The answer is not investigating cities and neighborhoods and just simply kind of using anecdotal data was my biggest investing mistake. I actually created an hour-long course on how to avoid it. It's called Location Magic. Just Google the 2 words, Location Magic, and my name, and the course comes up.
All right, perfect. What deal structure do you prefer as a general partner? A pref or a split? straight
Okay,
split.
well, I'm gonna break that question into two pieces.
All right.
The only deal structure that I prefer is one where I keep 100% of the profit and my LPs get nothing. Now you might say that is a fictional
Okay.
structure. The answer is no. I've my last two deals, I kept 100% of the profit. There's ways to get around this. Now, uh, but speaking in generalities, in my mind, 7 pref 70/30 is is a preferred model than the straight 80/20 model, simply because investors still like that word 70 a lot more than 80. They don't fully understand what they're doing. So I think 7 pref 70/30 is still a preferred model, though I think that if you did a statistical analysis and you had two deals, one at 7 pref, one at 6 pref, both would end up with the same amount of investor money.
Houston quickly. What's their thoughts on
Um,
Houston?
Number one market in Texas over the next 10 years, undoubtedly.
Even with oil, the way it is, it
Only
doesn't matter.
8% of Houston economies is oil, and 80% of Houston's growth has nothing to do with the word OIL.
It's all healthcare.
There's a lot of different things happening,
Yeah.
but 6 out of 10 jobs, as this is the Texas Bureau of Labor, not me.
Yeah.
They're projecting that 6 out of 10 jobs in Texas in the next 10 years are in Houston. So that's more jobs than Dallas, Austin, San Antonio, and Fort Worth combined.
And that's why people
All the
keep moving
jobs.
there. It's all jobs. All right.
Yep.
So we should be buying more in Houston. Um, inflation. How much? How fast? 2%?
Oh,
Like,
I just went from 5.1 cap to 4.7. Do you know how fast that is? It's insane fast. It's going to make your head spin, Roy.
um, how should an LP find I think it's quality GPs to invest with.
Honestly, my only answer is I'm invested with, in 16 syndications passively. I speak to people that have completed multiple cycle. So I ask the GP, send me people that have done at least two deals with you and they've completed those deals, they've exited those deals. I only want to talk to those people.
Got it. All right. I'm gonna stop there, Neal. I appreciate your time tonight. I'll let you finish with some parting words to the group. We still got 170 people on here. Any parting words? How people can reach you as well, and we'll
Absolutely.
wrap it up right
Yeah.
there.
Well, my feedback to you is this: be nimble in these times. So, the more pain there is, the more opportunity there is. And COVID's created a great deal of pain. What you have to be investigating is where is that pain and how can you take advantage of it? Don't tie yourself to one model. Be nimble, move around. There's an incredible amount of opportunity and a ridiculously large amount of money, right? And never overpay your LPs. That's another one I tell people. Most syndicators are overpaying LPs. You do not need to do that. If you'd like to know how I'm making 100% of deals, you're welcome to go to Grow Capitalist and look at some of our deals. An easy way to find me is simply by Googling my first and last name. You don't have to do anything else. Just type in Neal Bawa into the internet, hit enter, and you'll see some of my recent stuff come up.
Well, I appreciate it.
And by the way,
Yep.
thank you to Paul and thank you to James for having me on. This was awesome.
All
Neal,
right.
thanks very much. We appreciate that. And before I let you go, Neal, can you? A lot of people don't understand your management piece in the Philippines. Can you just talk very briefly how your assistants in the Philippines help you so much in managing some of these properties and what some of the
Sure.
things that they do?
Sure. Hang on. Let me switch my camera back on. There we go. Um, so I've never believed that property managers in the US optimize properties. I mean, one leasing agent, sometimes when they're showing people, nobody's picking up the phone. They're only calling people back once. They're only texting people once. I always felt that there was a better solution. So I built a call center in the Philippines, completely owned by us. Everyone's an employee. They're not contractors. They don't work through some other company. They work for us. There's 18 of them. And so we do 6 different buckets of things that improve our properties. So the first one is called mega marketing, where they generate thousands of leads. They're sitting on Facebook, chatting with people. They're generating leads from different engines. They're clicking on ads to bring them back to the first position. And we generate a massive number of leads for our properties. And then the second one, which we don't do at all of our properties, a property has to be doing poorly for us to attempt it, is called mega leasing, where we take those tens of thousands of leads and we actually call them within 5 minutes of the leads coming in. We call this the platinum rule. So if you call back in the first 5 minutes, you'll almost certainly get an appointment. Call back 8 hours later, you have 1/10 of a chance of getting an appointment. So we have a call center that basically calls people and schedules appointments directly into the property management database. Now, keep in mind, we're not property managers. We have no interest in ever being property managers. We simply act as an efficiency layer on top of an existing property managers. We irritate the heck out of our property managers in the first 3 months of ownership. Then they understand what's going on. Usually by once the first year is completed, they're all trying to copy what we're doing, right? But the first 3 months, they're like, what the heck are you doing? I mean, let us do our job. And the answer is, you don't have the resources to do your job, right? A 200 unit property that is getting 100 leads a week, one leasing agent simply cannot process that properly. Technology doesn't allow it, time doesn't allow it, and you've only got people working 8 hours a day. So I built a system that was better. And we do all kinds of things. We do delinquency management at properties that have high delinquencies. It's been useful for COVID. We also do reputation management. So when there's a maintenance call completed, we call up, and if they're happy, we ask for a review. And that gets our reviews up on Google and Yelp and apartments.com. There's 100 different things that we do, but the consistent thought process is this. There's no way any property manager in the US can do all the things that they promised to you when they signed the contract with you as the owner. They can't do it. The system isn't designed for that. So we simply found our way to optimize it.
Phenomenal. Thank you, Neal, for being on tonight. And if anybody needs more information, Google Neal Bawa and Grow Capitus. We appreciate it, Neal.
Thanks so much for having me on.
All right, thanks. So this next portion we'll go into, we'll have our breakout session. And the very first question I want you to answer in the breakout session is your biggest takeaway from Neal's presentation, and what will you change because of it? So we'll go into the breakout rooms, do a brief intro of yourself, and then we'll share what your takeaways were. So give me a minute, and I will put us into breakout rooms here.